All right, let's jump right in. We're going to talk about two massive forces that, honestly, are kind of running the financial world from behind the scenes: volatility and liquidity. By the end of this, you'll get what they are, see how they're connected, and it'll totally change how you look at the market moves you see every single day.
So to really get our heads around this, let's kick things off with a pretty wild question. How is it possible that a single political decision, literally just a signature on a piece of paper, can wipe out over $100 billion in market value? Just like that.
And look, that's not some made-up number for effect. We are talking about a very real loss, over $100 billion for America's top Fortune 500 companies. And this all went down because of a single U.S. executive order back in 2020. So what exactly happened?
Yeah, this wasn't just, a typical bad day for the market. No, this was something different. It was a direct, almost surgical strike, a reaction to one very specific policy change.
Okay, so here's the timeline. On June 22, 2020, an executive order was signed, and what it did was suspend new work visas. We're talking specifically about the H-1B and L-1 visas, which, are the ones big companies often use to bring in highly skilled talent from overseas. The immediate impact? Bam! Nearly 200,000 foreign workers were suddenly blocked from coming into the U.S. to work for these companies.
And the market's reaction was, well, it was instant. A study on this showed a huge drop in stock returns for those Fortune 500 companies. And the ones that got hit the hardest? You guessed it, the firms that really relied on that skilled immigrant talent. All told, the market reaction completely erased over $100 billion in shareholder value. Gone.
So you got to ask, how does something like that happen? How does a policy change cause such a massive financial hit and so fast? The answer isn't really about the politics of it all. It's about the fundamental mechanics of the market itself. And it all boils down to those two words we started with: volatility and liquidity.
All right, so let's really break these two things down, because once you get them, you're going to see exactly why they were the driving force behind that whole $100 billion event.
First up, liquidity. So what is it? Put simply, liquidity is just how fast you can turn something you own back into cold, hard cash. Think about it. A super popular stock, that's highly liquid. You can sell it in seconds. But an illiquid asset, say a rare piece of art, that could take you months, maybe even years to find a buyer and sell.
Okay, then you've got volatility, and this one is all about price swings. It's basically a measure of risk or, how unpredictable something is. A super volatile stock can jump all over the place day to day, while a less volatile asset, much more stable, much calmer price-wise.
A really easy way to see how these two are connected is to think about property. Let's say you invest in a publicly traded property fund, like a REIT. It's super liquid, right? You can sell your shares in minutes. But it's also going to be pretty volatile because its price is going to swing with the daily mood of the stock market. Now, on the flip side, what if you actually own a physical building? Well, that has really low liquidity. It could take you months to sell, but its value is also way less volatile. It doesn't change dramatically day to day.
Okay, so we've got liquidity, how easy it is to sell, and volatility, how big the price swings are. Now let's connect them, because there's a really powerful rule here that kind of governs how markets actually work. And here it is. This is the crucial point. Asset prices, they are fundamentally driven by changes in liquidity. The amount of money flowing in and out of the financial system, that's what makes prices go up and down. It's not always just about how well a company is doing, it's about how much cash is floating around to buy its stock. And this isn't some new idea. We're talking way back in 1988. The legendary investor Stanley Druckenmiller pointed this out. He said that the best time for stocks isn't when the economy is booming. It's actually when things are kind of dull and slow, and the Federal Reserve is trying to kickstart it by pumping more money, more liquidity, into the whole system.
This gives us a simple rule of thumb that's been true for ages. It goes like this. When you add liquidity, when more money flows in, volatility usually goes down. Things get calmer. But when you remove liquidity, when money is taken out, volatility usually goes up. Things get a lot choppier.
So if liquidity is the key, if it's the thing that really moves markets, then the next obvious question is, who's in charge of the tap? Who's turning the money faucet on and off?
The answer? The world's central banks. We're talking about institutions like the U.S. Federal Reserve, the European Central Bank, you get the picture. Through all their different policies, they are the ones controlling the flow of liquidity for the entire global financial system.
And if you want a perfect example, just look at the decade after the 2008 financial crisis. The Fed's balance sheet, which is just a way of seeing how much money they were pumping into the system, it grew like crazy. They did this through something called quantitative easing, which is just a fancy way of saying they created a ton of new money. And what happened at the same time? The S&P 500 went on an absolute tear. The correlation there is pretty hard to miss.
Okay, so that's what happens when you turn the money tab on full blast. But what about when you start to turn it off? What happens when you reverse the flow?
Well, we got the perfect test case for that back in late 2018. For the first time in 10 years, the Fed actually started to shrink its balance sheet. They started taking money out of the system. And honestly, it wasn't even that big of a reduction, but the market's reaction, it was violent. The S&P 500 dropped almost 20%. Taking that liquidity away was the direct trigger for a huge spike in volatility.
So all of this, it all leads us to this one timeless piece of advice for the markets. And it's probably more important today than it has ever been. It comes from way back in 1970. A market analyst named Martin Zweig came up with a phrase you still hear all the time: don't fight the Fed. And his point was so simple, yet so powerful. The central bank is the biggest player in the game. If you try to bet against what they're doing, you're probably going to lose. And that advice is just as true today as it was 50 years ago. It doesn't matter if a central bank is adding liquidity to calm things down or taking it away to fight inflation. Whatever they do has a massive impact on prices. So, for anyone watching the markets, that means you absolutely have to pay attention to what the central bank is up to. It's a huge clue for where things might be going.
Which kind of leaves us with one last big question to think about. You know, we like to imagine the market as this democratic thing, the combined decisions of millions of different investors. But if central banks control liquidity, and liquidity is what drives prices and volatility, then who really holds the power? Who's really in control?